Hi everyone, welcome back to the channel. Today I am doing a detailed financial analysis and strategic analysis of Anthem Biosciences Limited's Q1 FY 2026 results, their very first quarterly results post listing. I will break down the numbers, dissect growth drivers, and share some management insights straight from the earnings call. If you enjoy in depth coverage and actionable insights, stick around till the end. First, a quick backdrop. Anthem Biosciences is a leading CRDMO contract research, development, and manufacturing organization serving the global pharma and biotech industries. After their successful IPO, Q1 FY 2026 marks their debut as a listed company. Let's dive into the results for Q1 FY26. Total revenue is Rs 563 crores, up a strong 57% year on year and 13.2% quarter on quarter. Revenue from operations is rupees 540.2 crores, up 59.5% year on year and 11.8% quarter on quarter. EBITDA is at 214.3 crores, rising 53% year on year, and EBITDA margin is robust at 38.1%. Profit after tax is rupees 135.8 crore, up nearly 65% year on year, and profit margin is healthy at 24.1%. Net cash position is 784.8 crore rupees as of June 30th, 2025, further strengthening the balance sheet. These numbers signal a company firing on all cylinders, especially for its first public quarter. Let's dissect the top line growth. CRDMO business, the clear growth engine contributing rupees 452.7 crore, up 70.5% year on year, forming nearly 84% of the operational revenue. Specialty ingredients at 87.5 crore rupees, showing steady 19.7% year on year growth, but a slight dip on quarter on quarter basis, a segment to watch for future margin rebalancing. Margins remain best in class. EBITDA margin at 38.1% for Q1 FY26, down slightly from 39.2% year on year and 42.1% quarter on quarter, reflecting a change in revenue and product mix and a one-off ESOP related expense of 4.4 crore, affecting the margins by 0.8%. Gross margins. Management attributes a quarter on quarter dip to lower R&D revenues, which have higher margins. Q4 FY25 had a larger share of higher R&D projects. Profit after tax at 24.1%, reflecting both operating leverage and strict cost controls. Operating cost, material cost, employee benefits, and other expenses have all increased year on year with business scale. Other expenses spiked 93% year on year, mainly due to commissioning of new capacities, higher power and fuel cost, as well as CSR spend in the quarter. Now let's look at the capex and investment highlights. The company is doing significant capex at its unit 2, 3 and 4. It completed the expansion of 54 KL custom synthesis capacity at unit 2 and commenced commercial operations. It also completed and commenced operations at unit 3 in a phased manner. Commenced operation at a custom synthesis block comprising R&D lab, pilot lab, kilo lab and hydrogenation facility. Inaugurated new state-of-art dedicated commercial scale peptide manufacturing facility and commercial scale high potent manufacturing capacity. It also broke ground and construction is underway for a new greenfield facility at 30-acre site at Harohalli, Bangalore. Now let's look at the business drivers and strategic outlook. The top line growth. Extraordinary 57% YOY revenue growth was driven by increased sales of commercial molecules across major clients. 5 to 6 product categories saw strong volume uptake. Management calls out Q1 as exceptional but reaffirms a 20% plus long-term CAGR trend, preferring to wait and watch future quarters for consistencies. Pipeline and modalities. Commercial product portfolio grew from 10 to 12 molecules, with commercial portfolio now mostly with large pharma. Late stage pipelines are still robust. Special efforts in new modalities, ADCs, peptides, RNA, and lipid products. Commercial capacity for ADCs and peptides is now operationals. RNA and lipid projects remain in advanced development, but not yet meaningful revenue contributors. GLP-1, a high-profile peptide, is a focus area. Company sees itself as a capable global competitor, including against Chinese peers, given their new peptide manufacturing scale-up. Now let's look at the risk and challenges. Political and regulatory risk. Management is alert to global uncertainties. US EU drug pricing, most favored nation policy, and possible tariffs. Flexible sales and supply chain channels can partially insulate against direct region specific policy shocks. Execution risk, ongoing capex and expansion demand flawless execution. Utilization stood at 70% for synthesis and 50% for fermentation at quarter end, indicating some headroom but not excess slack. Customer concentration, although well diversified molecule, there's a concentration at customer level in commercial supply, a common feature for CDMOs. If you are following the India Pharma outsourcing story or looking at the strategic compounders in the healthcare sector, Anthem should definitely be on your radar. That's all for today. If you found this valuable, hit that like button, subscribe for more deep financial dives, and let me know your thoughts or question in the comments below. See you in the next one.